Did you know that only about 20% of investors consistently beat the market? And here's a shocker. Most fail because they don't follow a proven strategy. But what if you could learn from one of the greatest investors of all time, Philip Fisher? His book, Common Stocks and Uncommon Profits, holds secrets that can transform your investment approach. Imagine having a method that lets you pick winning stocks like a pro. Fisher's strategies aren't just theories, they've stood the test of time. For instance, companies that focus on innovation tend to outperform their peers by up to 30%. That's a game changer for your portfolio. In this video, we'll dive into Fisher's top investment tips. You'll discover the power of the Scuttlebutt method, getting insider info from everyday conversations. We'll break down Fisher's checklist for spotting growth stocks. Plus, learn why timing the market is more myth than mastery. Stick around to see how these timeless strategies apply to today's market. By the end, you'll be equipped with insights to make smarter, more profitable investments. Ready to unlock these secrets? Let's get started. Chapter 1. Unlocking the Scuttlebutt method. Have you ever wondered how top investors consistently make winning decisions? It's not just about crunching numbers, it's about something Philip Fisher calls the Scuttlebutt method. This approach is all about tapping into the grapevine. Yes, just like the gossip you hear around a water cooler, but for stocks. Fisher believed that valuable insights come from informal sources just as much as from financial reports. So, how do you use this method? Start by talking to customers, suppliers, and employees. These are the people who know the company's day-to-day operations best. They can tell you if a product is well received or if there are any red flags. Fisher famously said, "If you don't do enough scuttlebutt, you'll end up with more bad investments than good ones." And who wants that? It's interesting to note that despite advancements in technology, this method still holds up. A 2019 study showed that analysts who conducted independent channel checks, a modern-day scuttlebutt, outperformed their peers by 6.3% in terms of investment returns. This shows that old-school tactics can still give you an edge in today's digital world. Investing is not just about what you know, it's about who you know. By engaging with a network of informed individuals, you gather insights that financial statements might not reveal. For example, if a supplier mentions a spike in orders, it could indicate rising demand before it's publicly known. This inside scoop can be your cue to consider buying stock. Remember, the key is not just to listen but to ask the right questions. Dig deep. Is the company innovating? Are employees happy? What's the buzz from industry insiders? This kind of information is gold when it comes to investing. Chapter 2. The DNA of great companies. What makes a company truly investment-worthy? According to Philip Fisher, it's not just about current profits but about identifying companies with the potential for future growth. Fisher's criteria for evaluating a company are like a blueprint for spotting winners in a crowded market. One major sign of a promising company is its dedication to research and development. Fisher emphasized that companies which continuously innovate tend to stay ahead of the curve and provide long-term value to investors. Think about tech giants who invest billions in R&D. Their market value often reflects their commitment to innovation. Another crucial factor is the company's ability to attract and retain talented employees. A great company is only as good as its people. Fisher pointed out that companies with low turnover rates and high employee satisfaction often perform better financially. This isn't just speculation, statistics back it up. Research indicates that companies listed in the 100 best companies to work for outperform their peers in stock returns by up to 3.8% annually. Fisher also talked about the importance of superior sales organizations. A company with a strong sales team is more likely to effectively promote and sell its innovative products. This drives revenue and, by extension, stock performance. For instance, companies with highly rated customer satisfaction scores tend to exceed the market's average growth rates. Finally, the quality of the company's management is paramount. Fisher advised investors to look for management teams that are forward-thinking and ethical. It's these leaders who navigate companies through ups and downs, ensuring sustained growth and stability. By following Fisher's guidelines, you're not just investing in a company's current state but in its potential to grow and adapt in the future. This strategic approach is what separates average investors from the truly successful ones. Chapter 3. Innovation as the investor's best friend. When it comes to long-term investment success, innovation is your best friend. Philip Fisher was a strong advocate for investing in companies that prioritize innovation. Why? Because these companies are the ones shaping the future. They're not just adapting to changes, they're creating them. Fisher famously said, "The best time to sell a stock is almost never," implying that innovative companies are often worth holding onto for the long haul. Consider this. Companies that are leaders in innovation report revenue growth 3 times higher than those that lag behind. This isn't just about tech companies. Industries across the board, from healthcare to manufacturing, show that continuous innovation leads to better financial performance. For investors, this means looking for companies that are constantly developing new products or improving existing ones. But how do you spot these innovators? It's not just about who spends the most on research and development. Look at the culture of the company. Is innovation encouraged? Are there systems in place to foster creative thinking? These are crucial questions that can help you identify true innovators. Another key indicator is patents. While not all patents lead to successful products, a consistent flow of patents indicates a commitment to innovation. For example, a company that consistently files for and receives patents is likely pushing the boundaries of what's possible in their industry. Investing in innovation is investing in a company's future. And while it might be riskier, the potential for significant returns is substantial. Fisher understood this well, advising that the potential for increased earnings from such companies often outweighs the risks. Chapter 4. Timing the market. Myth versus mastery. The debate over whether investors can consistently time the market is ongoing, but Philip Fisher had a clear stance. It's more about knowing what to buy and holding onto it rather than trying to time your purchase perfectly. Fisher argued that the right time to buy stocks is less about market trends and more about the company's potential for growth. Here's an interesting point. Studies have shown that most of the stock market's gains come from just a handful of days. If you're always moving in and out of the market, you risk missing these crucial days. Fisher's strategy focuses on finding great companies and staying with them through market fluctuations, not jumping ship at the first sign of trouble. This approach requires patience. Fisher emphasized the importance of a long-term perspective when investing in stocks. He believed that if you've done your homework and invested in a fundamentally strong company, short-term market variations shouldn't be a cause for panic. Fisher also pointed out that if you're constantly worried about the best time to buy or sell, you might be focusing on the wrong things. The emphasis should be on the company's performance and potential, not the market's every hiccup. A company with solid fundamentals is likely to perform well over time, regardless of market volatility. Lastly, it's essential to understand that timing the market is not just about when you buy, but also when you sell. Fisher advised against selling simply because the price of a stock has gone up. Instead, the decision to sell should be based on changes in the company's fundamentals, not just its stock price. By focusing on the company rather than the timing, investors can sidestep the myth of market timing and work towards genuine mastery of their investments. Chapter 5. The Growth Stock Checklist. Investing in growth stocks can be like finding a diamond in the rough. It's all about knowing what to look for. Philip Fisher provided a roadmap for this in his famous 15-point checklist to evaluate potential growth stocks. This isn't just a list, it's a deep dive into a company's vitals. The checklist isn't about finding perfect companies but identifying those with significant potential for growth. First off, let's talk about product innovation. Does the company have products that can lead the market? This is fundamental because, as Fisher pointed out, companies that fail to innovate often fall behind. Consider Apple's introduction of the iPhone. It wasn't just a new product but a whole new category that reshaped the company's future. Another crucial point is the company's sales organization. Is it strong enough to sell an innovative product effectively? This matters because even the best products need strong sales strategies behind them. Statistics show that companies with effective sales teams increase their chances of sustained profitability by over 30%. Also, look at how the company treats its employees. Fisher emphasized that companies that look after their employees tend to enjoy low turnover rates and high morale, contributing to productivity and, ultimately, profitability. A study by Gallup found that companies with highly engaged workforces outperform their peers by 147% in earnings per share. Financial strength is another key factor. Fisher advised checking the company's financial statements for strong fundamentals. A robust balance sheet isn't just comforting, it's a sign of a company's ability to invest in future growth opportunities. Finally, does the company have a competitive advantage? This could be in technology, market dominance, or even regulatory approval that protects its market position. A competitive edge can mean a smoother path to higher and more stable returns. Chapter 6. Beyond the page. Applying Fisher's principles today. How do Philip Fisher's investment principles hold up in today's fast-paced market? Remarkably well. Let's apply Fisher's criteria to modern companies to show how these timeless strategies can still guide us to smart investment decisions. Start with innovation. Companies like Tesla and Amazon are constantly pushing boundaries, much like the innovative companies Fisher admired. Tesla's advancements in electric vehicles and energy solutions mark it as a leader in innovation, while Amazon's continuous expansion into new markets defines what it means to be forward-thinking. Next, consider leadership and governance. Fisher knew that strong leadership is critical. Look at Microsoft under Satya Nadella's leadership, which has seen its stock price soar thanks to strategic decisions around cloud computing and enterprise services. This aligns with Fisher's view that management's actions are crucial to a company's success. Then, there's customer loyalty. Brands like Apple maintain a fiercely loyal customer base, which can be a significant competitive advantage. This loyalty comes from consistent product quality and innovation, echoing Fisher's advice about the importance of a company's relationship with its customers. Lastly, let's talk about financial strength. Alphabet, Google's parent company, continues to show robust financial health with consistent revenue growth and strong cash reserves, allowing it to invest in future technologies like artificial intelligence and quantum computing. By following Fisher's principles, investors can navigate the complexities of modern markets and identify companies with enduring value. These strategies are not stuck in the past, they're as relevant today as they were when Fisher first wrote them.